Welcome back to the Compassionate Capitalist Show. We're going to, I've been having a few podcasts lately talking about artificial intelligence and, the hoo-ha about it, the way people have been using it for a long time as a productivity tool. And today we're going to talk about it from a different perspective because my guest, David Marra, has really been a trailblazer in this space. He's a fund manager involved in hedge funds, AI investing. His key focus is growing wealth and providing income with less risk for large losses. And that will, as we talk, you'll see it'll apply to how you run your business, how you run your investment portfolio, and really how you plan for, long term on that, because we do know that the market, everything is volatile. There is risk associated with everything. And so with specific techniques that David has developed over the years, he's been able to help his clients and all different across the board to manage those risks and that the tumultuous nature of the market. So let me tell you a little bit more about David, and we'll get into what we're talking about. He's a trailblazer in quantitative asset management and stands at the forefront of financial innovation using artificial intelligence to enhance investment strategy. He is the head of research and portfolio management at Markin Asset Management. And prior to founding Markin, he found a quant investment research firm serving institutional managers, as well as spent a time as the principal at the Boston Consulting Group, and was a founder and CEO of a search engine tech firm overseeing 70 machine learning researchers and technologists. So when I was looking through, welcome, David. Welcome to the Compassionate Capitalist Show.
Hey, Karen, it's nice to be with you.
Thank you. So when I was going back through that intro and like that, I could not help but to think about, and now I'm going to forget the name of the show. I didn't look it up ahead of time. Billions on Showtime, and the quant analysts that they brought in that really, boosted the performance of their portfolios and their funds. Are you familiar with that show?
I am. In fact, that show is loosely based on one of the hedge funds, which is just up the road from us, actually. Yeah.
Okay. So when so the way she had put together all these quant researchers to, come up with the deep data analytics of deciding, do they acquire, do they do all these different things? Is that a similar sort of approach that Hollywood has glamorized when it comes to quant analytics and machine learning?
So I've only watched that show. Being in the business, I don't like to watch shows about the business, so I don't watch that show very much. But I certainly understand the appeal, and I have caught a couple episodes. And I mean, very loosely speaking, I think the answer to your question is yes. I mean, a quantitative investment manager like myself wants to look at a lot of data, wants to combine that data with a mixture of what I would call Chicago style economics. I'm a graduate of the University of Chicago Business School, where I received my education in finance. And, that's what I would call, leveraging the work of the economic community and the many Nobel laureates, that have come from the University of Chicago, but leveraging the knowledge that has spanned from Adam Smith to the present about everything we know empirically and theoretically about how financial markets work and how investing works, with marrying that with what I would call Stanford, right? Which is statistical learning, large amounts of compute and large amounts of data. And the show Billions, captures that through the kind of scenes that you just mentioned, and a similar, in approach to what we do. I think the difference is everybody in kind of quantitative investing has their own take on their own secret sauce, if you will, about how they go about it. And some are pure kind of statistical type of investors. We are much more a combination of that Chicago plus Stanford approach that I talked about, kind of building on the shoulders of Adam Smith and quantitative learning, if you will.
Okay. So let's connect the dots for the listeners. How you came to start the SEO firm? How long ago was that? Because I would think you were pretty much on, if you bleeding edge, if it was say 20 years ago that you were doing the SEO firm and doing the machine learning. That was when people were really just trying to figure out what machine learning and that kind of stuff was. So how you went from that into the finance space to be able to apply that with all this wisdom that you have gained on insights into the market.
Sure, happy to tell you just a little bit about how I came to this, and it's a bit of a circuitous route, as I think there are a lot of people in finance, come to finance from a unique route. My own journey was started really after business school in Chicago. A few years out of Chicago, I was a management consultant, and really the internet was happening. I graduated business school in the mid 90s. And this was the late 90s when I started thinking, wow, like this internet thing is really taking off, and where is the action really going to be at over the long term? And I identified search engine technology as like the one of the long-term players, and was absolutely right on that, right? But I didn't found Google, so I missed the mark there. But we got started actually at the same time as Google, and it was the frontier at that time of search engines. I mean, there were many players in the space, and now there are just a handful. But what it taught me was, and it was really my first deep dive into technology. I had a patent pending on our own search engine algorithm, and was, what you could do with code, with data. I was interested in it, and it was my first time to run a company that was really leveraging it in a new way that technology newly allowed. After that venture, I got thinking about how could I combine what I had learned at the search engine firm with what I learned, what I was educated in, which was finance. And that started a journey for me, which really led to me kind of coming up to speed on what the state of quantitative finance was at, and where I thought I could add some value in starting a new company. So in 2010, I founded an quantitative investment research firm that brought all these ideas together. Let's bring data, large amounts of compute, and new generation of algorithms, machine learning type algorithms, now called artificial intelligence, with investing. And you're absolutely right, Karen, at the beginning. I can remember pitching this idea to investors back in 2009 kind of time frame. And people at that time, while there were a few believers, and I did get investors, and all your entrepreneurs who listen to your show will sympathize with this, right? We're all fellow entrepreneurs here. Was a lot of people just didn't want to hear the story that a machine could manage an investment portfolio as well as or better than a team of human beings.
Okay.
Right.
Yeah, they still don't like to believe that.
Right. But they've come around to the idea that if you pitch the story more as, well, it's not machines versus humans, it's a team of programmers versus a team of non-programmers. Right.
Okay.
That's what it really is. It's still humans against humans, if you will. It's a competitive space, investing is. But it's all about thinking about how we can do our processes in a more scientifically rigorous, data robust way. And that's what data, programmers, algorithms, Adam Smith all helps us do.
Okay. Yeah. So get kind of digging into that, because, let's get into sort of, this whole idea about artificial intelligence. They're predicting that it's, the stocks that are, I guess, AI stocks. To me, I always think of AI. I think of AI as a tool that is used to do something with that becomes the company. So are they looking at AI stocks, in air quotes for those that aren't watching? AI stocks are they're not straight up AI. They're some outcome of using the algorithms of artificial intelligence that's producing a tool or a product or a outcome, right? I mean, there's not,
right.
It's not a pure AI play.
Right, exactly.
Right? Because there's not one algorithm that is all of AI. It's, because I just finished, I had come across this I was cleaning my office for New Year's. This is 2018 article about 25 ways artificial intelligence is changing business. And it mentions in here Robinhood. Now, like, I did not know Robinhood had an AI core to it. Did you know that? Did you know that Robinhood, is that kind of why they can predict the things that they predict?
So I'm not too familiar with that particular reference, but
Okay.
but to get to your question, and
Yeah.
you are absolutely on the right track here, which is, again, what we did after the investment research firm 3 years ago, I co-founded along with my partner, Markin Asset Management, where we actually offer, investable vehicles to advisors and to individual clients, to be able to invest in our quantitative strategies. But to answer your question, there's really two things going on here, right? The first is what you mentioned, which is, and in your reference to the Billions show, what we're doing is we're building, very simply put, a technology that's purpose built for the investment vehicles that we offer, or if some other firm is doing it for what they offer, hoping that the benefits of more systematic and scientific management will allow us to better manage for risks and also better manage for return, right? That's the objective, and that's what we're doing. So you're using these AI and machine learning technologies and data technologies, a lot of technologies that go into it to do that. The other thing is, as you mentioned, we're also separately investing in all kinds of stocks and also other asset classes. We invest in bonds, we invest in currencies, we invest in commodities, for example. So we're looking at stocks and saying, AI is a theme now to drive company margins, to drive company growth rates, to lower costs, right? AI can enhance productivity, and vis-a-vis productivity, enhance earnings per share. So we're also separate from using the technology. We're actually using the technology then to identify stocks that are going to be enhanced by this theme of artificial intelligence.
Okay, so let me see if I can put that into layman's terms, see if I understand it. So for example, if you were looking at a publicly traded company and they you do some form of an analysis or correlation that says, let's say it's a manufacturing, and they decide, they announce they're adopting AI technology to better manage manufacturing flow based off of supply chain availability of raw materials. Let's just say so they can look out and say, so we're going to schedule people because we know we're getting all of our supply in and we need to do all this stuff, but we won't have idle time otherwise. Hypothetical, right? So that would in theory then show that they're going to increase their efficiency and therefore improve their bottom line, because they may not have inefficient operations of people, as well as, excess inventory or things like that. Is that so? You would look at how they're using AI to improve their bottom line and then see that this company has a longer future potential, assuming the other correlations are correct. Is that how you're talking about when you're looking at how AI is being used? Or is it the software company that does that analysis work for the manufacturing company, and that's a target of an investment?
So it's the former rather than the latter.
Okay.
So the latter, the latter case that you identify, is investing in tech firms that make the plumbing, the AI plumbing, right? They're involved in the data centers or the chips or the algorithms, and other related things. Those firms have already experienced a rapid increase in their prices, right? We witnessed that in the middle second half of last year, right? So the Googles of the world, the NVIDIAs of the world, the Amazons of the world who run the data centers, the algorithms, and the chips in all three of those examples. Those are firms that a lot of, certainly not all of, but a lot of the future cash flows from artificial intelligence are already priced in. From an investor's perspective, we want to look for the parts of the investment space, the liquid investment space, the stock space, where we can invest in opportunities that are not yet priced in. And those are the firms largely in other industries, not exclusively, but largely across all industries, where we can invest in that and do it at a price level whereby there's going to be a lot of future price increase that the investor can realize as a return.
Okay, and so then how does AI fit into that, looking at those other industries?
So, I mean, you outlined an example
Oh, okay.
of a
Okay.
logistics company or a company where
Okay.
supply chain is very important and AI could potentially play a role. Another example would be a lot of AI is playing a role on the customer service side, the marketing and sales side, where a lot of processes today involve a lot of different people, right? You call a customer service person, or you or in the case of marketing and sales, you're using people to identify sales opportunities, or you're using people to create marketing content, like marketing photography, marketing copy. These are things that artificial intelligence in people who use ChatGPT today will readily recognize are things that generative AI can deliver against, right? It can if it's not replacing people, it's certainly providing greater productivity to people. An individual now can create more marketing copy of a more specialized nature much more quicker than they could a year ago. So
Right.
these are the kinds of places that firms are actively investing and finding where they can implement generative AI.
Yeah. So not to put you on the spot or, but because you are such an expert, and we did, when we first had our intro conversation, we did talk a little bit about the, angel investing and my approach of, the balanced portfolio kind of a thing. And I think you have been involved some in angel investing in the past, if I recall. So my question to you is, knowing what you know about the public AI stocks that are the pure play AI, if somebody was trying to, that whole term, proverbial term, skate to the puck, right? So they're trying to anticipate where are the gaps in the pure play AI space that somebody might be working on developing. Do you see sectors of pure play AI that are not overly populated yet, or don't have, like, it would be hard to go up against ChatGPT at this point in time? So, that there's opportunity out there because you've been analyzing AI within the market, because they're predicting AI is going to be the next bubble now, because everybody's jumped on this bandwagon that pretty much anything with AI gets, is worth an investment. And we know from, .coms, right, and pet stores online that, the market can only bear so many of them. So unless you're going to invest in all of them, right, might need to spend some time noodling on where's that puck, where's the goal.
So I ran a .com, so I can appreciate that. They appreciate that. So
Right.
in a very visceral way. Yeah, I mean, at that time, actually, just to clarify, yeah, I've never been involved in angel investing, but I was a recipient at that time of, a large amount of venture capital. So I know how the process goes. And have founded now, three companies, founded or co-founded three companies in my life. So on the question of bubble, because let's talk about that. That's the first question investor has to ask. If I'm going to put all of my heart and soul into something, I need to put my heart and soul into something that's going to be around for a while, right? The average entrepreneur, the statistics show, right? The average entrepreneur takes 7 to 10 years to succeed, right? So there are people who succeed in 1, 2, 3 years, but the average is 7 to 10. So and that means the average is there's people who took 12 or more years. So you want to, obviously the entrepreneur wants to find a good opportunity. It's going to be around for a while. So let's talk about the bubble and whether AI is a bubble. So I've been involved in AI in a couple different dimensions, right? Not only from this kind of programming side, building the code, building the engine, so to speak, and then from the investing side, but I've also been involved in it from, and you mentioned it at the start, my management consulting days, right? And where a good portion of that management consulting was helping firms to implement machine learning and AI-based systems into their business processes, right? So really in the guts of how you implement this stuff to drive earnings per share. And I can tell you that when you go back to the pre-chat GPT, so you go back to, even just a year ago, 2 years ago, 3 years ago, these systems, these machine learning systems were very, very hard to implement in a company. You had to have very particular data sets. You had to have a lot of data. You had to build your own bespoke algorithms that match that data very well. And often the business payout was several years away, right? That was the paradigm coming into. Then ChatGPT comes along, and just let's call it generative AI more generally, because it's obviously other firms working on it and delivering it.
Okay.
But now this generative AI generation of technology is much, much easier for firms to implement across their business processes. And I gave a couple examples a little earlier, right? Right off the shelf these days, you can go to an AI provider that will build photographs for you that you can use for marketing, that will give you optimized text for marketing and sales purposes, right? Just two simple examples. Those things are pretty much off the shelf today. And the data sets that are required to make them unique to your firm are not that hard to come by like they used to be, because of these what are called foundational models, which is what the Googles and the Amazons, et cetera, are in the OpenAI, et cetera, are building. So with the foundational model, you can then, a lot of the basics are already built in. You can just bring in your own business subset to it, which builds on top of that and customizes it for your use. This process is dramatically simpler than, again, like 2-3 years ago. So the answer to your question of, is it a bubble? Let me answer it this way. That's the preamble. The direct answer to the question is, I don't think so. And this has been me as a participant in the industry now for 20 years, 23 years, I guess I'd say. And my evaluation is that this is the real deal. And I would answer it as follows. And I recently wrote a blog post on this. If your readers want to go to markinfunds.com and go to the Insights blog, you can read about it, but it's markinfunds.com. That's markinfunds.com. Go to the Insights blog.
And it'll be in the show notes as well for people to click on.
There we are. But if you were to plot a graph of global growth, right? Global growth rate, from, economists have it back from about the year 1500 to the present. Global growth is estimated from about 1500 to the present. If you go from 1500 to 1847, when economists mark the beginning of the Industrial Revolution, you will see a pancake, a flat line.
Yeah.
Global growth is essentially just a little bit above zero from 1500 to the start of the Industrial Revolution. You get to the Industrial Revolution, and it's that hockey stick you talked about earlier, Karen.
Yeah.
It literally is the hockey stick. It just, global growth rockets. Sure. And this is how I view AI today. I think that we're sitting at 1847, a new 1847, which is a new level of growth that's going to come out of the Industrial Revolution. Was a set of technologies. I think we're sitting at an 1847-like moment where future growth rates, global growth rates, are going to be much higher. At least, put it this way, there could be other drags on global growth, but this one factor, right? All other factors equal, in other words, this one factor has the potential to drive global growth much, much higher, and therefore puts another upward kink, like the Industrial Revolution did, in global growth rates. So I think it's the real deal.
Oh, yeah. So let me clarify kind of what I meant by bubble. All right. Because no doubt AI is here to stay, and machine learning, it's just going to get better and better. It is a part of things that we completely take for granted right now. when you ask your phone or you ask the thing sitting over there in the living room to go do something for you, that little device, it is using artificial intelligence to go figure out what it is and figure out what you said and figure out where in the world of data does it find what you asked for, right? Whether it's playing a song, ordering a thing of milk to be delivered, whatever it is, right? So there people, they're like, and it's like Big Brother is always listening, and that's because the little AI machine in your phone is trying to figure out, one, a lot of times for advertising, how to deliver what you were asking about when you weren't asking about it. We joke about that like all the time, that an article will pop up in my phone when I was having a conversation with somebody else and not even on my phone. And so and I know that it is a big part of, drug discovery. It's a big part of research and science. Is a big part of everything. And as I try to explain it to everyday people, the artificial is the computer, the intelligence is the humans that developed the programming, the algorithm. Algorithm is just another word for some of the code, the if then that but stuff that we used to do back in RPG 2 days, right? Not to age myself way much, but yeah, you know what I mean? So no doubt it's around. Same thing with VR and AR and stuff like that. It just gets better and better. The bubble was more in terms of this rush to the market that we saw with these stocks, and can they continue to go up, or there'll be a restructuring, a rebalancing, just because, just like we did with real estate, we did with .com, there was just too much out there. The market couldn't sustain it. The value propositions, or the market caps of those companies can't sustain that value forever. It'll reset and restructure, and some won't survive, some will survive, that kind of a thing. I just wasn't sure. So when I was talking, so I'm 100% absolutely on the idea that it is here to stay. And that's why I was trying to think about skating to the puck, right? But more, and this might be going into your topic of weathering the storm, right? And how you balance a portfolio so that you don't have just all hot trend topics, but or stocks, but you are balancing out to avoid large losses, right? And the large loss at this point would be buying the stock that's been going up for 2 months and like at its peak, right? So so within that context, I think we're in agreement as part of, answering the question about avoiding long losses. Maybe you can just use the example of the different types of stock bubbles that we've had to talk about, how you balance that.
Right. So thank you for that question. So our value proposition as systematic investors is, and there are different value propositions for different investment strategies, but very broadly speaking, our value proposition is, the investment set. What are good investment versus bad investments is temporarily varying, right? It varies through time, right? It varies through time, right? You sitting just in one type of stock, just for example, last year, technology stocks were the absolute worst thing to be in, right? Down 35% or so last year. Now, this year has been year before last. We're in a new year. We're in 2024.
Yeah.
So sorry, year before
Right.
last I'm talking about, 2022 was a very, very bad year to be in technology. Last year was a fantastic year to be in technology. So the investment opportunity set is time varying. Me as an investment manager, I want to help investors avoid large losses. And that's particularly true of any type of investor. Most investors have some sort of risk aversion, right? It's the very, very rare investor that just cares about pure return, doesn't care how much they're ever down. So what we try to do is use all that technology and all that data available to us to identify what are the things that we can invest in today that meet the target return of the strategy, and every strategy is a different kind of target return type of thing, meet the target return of the strategy, but take on as little risk as possible, right?
Okay.
It's easy to just constantly take on more risk, waiting for your investments to blow up in your face, right? And then have to wait for a decade for them to rebound.
Yeah, right.
Yeah,
That is what happens.
right. That happens, right? People who've been around a while know that that's what happens. It can happen, and so that's the role. Identify what is the best investment set to be in, but that also takes on as little risk as possible, or at least is within the risk budget of the investor, right? And that's the hard work. That's what keeps me, and all of us here busy all day. But that provides a lot of value to investors. And let me just take a minute to explain how that provides value. I know, again, a lot of your listeners are entrepreneurs, and an entrepreneur is a person who's got a lot of risk, very concentrated in whatever their firm is, right? They and a lot of senior executives are also like this. They were senior executive at Microsoft, probably got a lot of Microsoft stock, right?
Right.
And no matter how good the return is or the expected return is on an investment, it's very concentrated, which means it's high risk. Any one stock is, Markowitz, Markowitz teaches us that, lack of diversification increases our risk. So we want to look at the other part of the portfolio that is outside of that concentrated risk that the entrepreneur is holding and say, how can we best diversify that and minimize the risk of large loss? Because particularly those large losses are most likely to come along when your firm is also experiencing hard times.
Right.
Right. So decorrelate the risk and reduce the exposure to large loss is often the mission of someone like me for a high net worth entrepreneur, for example.
Okay, so how would they? What are your recommendations for offsetting the future loss, the inevitable losses that they may encounter from whether it's things like supply chain shortfalls or pandemic where you can't be open for business or whatever, things that, high interest rates that you weren't planning for, that we've all businesses have all experienced in the last 3 to 4 years. What would be, that's more on the business owner side that might be investing in other things besides their business, or that Microsoft exec that you talked about that has a lot of Microsoft stock, right? So do you have a strategy of how they do that? Is that,
So
or is
I
that
was
the
actually
secret
asked
sauce
this.
that you
Yeah.
can't give until somebody sets a call up with you?
No. So I'll give a multi-layered
Okay.
answer.
Okay.
The front, because I was asked this exact question at a conference last year, and what I said was, well, the best advice, the first piece of advice I give to that entrepreneur who's trying to manage the risks of their investment portfolio, their liquid investment portfolio, is find a good advisor whose investment philosophy you agree with, because you're too busy. You shouldn't be on Robinhood trading your options in your stocks while you're trying to manage your business. You should be trying to make your business as successful as possible, and that's a 24-hour a day job, as we know. You should find an advisor whose investment philosophy you trust. Our business is we work with advisors and ultra high net worth and high net worth individuals uh, um, uh, 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 who we primarily work through advisors, right? So and they understand how our investment product is going to fit into a client's portfolio, and they like what we're doing. And actually, we like what they're doing in terms of the service that they're providing to the end client. So that's how the ecosystems works, right? A portfolio manager like me, a hedge fund manager like me, works with advisors to get our product in their lineup, so to speak, their basket of things that they like to invest their clients' assets with. And they understand how our product fits into a portfolio. And for the individual investor, the best advice is find somebody like an advisor. You might, in some cases, you can find an individual manager, but find somebody like that who you trust, you like what they're doing, you agree with that investment philosophy, and invest those assets with them. But I know you were also, so that's my best advice. But I know you were also asking the other question, which is, okay, what are the actual strategies that can do it, right? And that's why I caution people. The investment set does change quite rapidly, and getting it wrong is quite painful.
Yeah.
The 60/40 portfolio in 2022 was down 18%. I think it ended to 17.5% for the year, and it was down 20%, I think, as a maximum drawdown during the year. That's a large drawdown for a lot of people. And that's the risk of being in portfolios which don't offer any risk management, whatsoever. We were able to do much, much better than that. And our clients were, certainly we were very pleased. And we think our clients were very pleased with our performance in protecting their capital that year. But it's a very difficult job to markets are. Let me summarize it by saying this way: markets move very quickly these days, very quickly. If you think about the number of market cycles we've been in just since COVID happened, it's about 4 major market cycles. And not only can not a lot of advisors keep up with that, which is why they employ professional managers like us, but the individual who just doesn't have the time, they're making their money somewhere else. Their opportunity cost of time is too high to be spending time doing this, and they're probably not the best person to do it anyway. So I don't know. That's the summary of my advice on that question, I guess.
Well, because I guess within the hedge fund, or you're balancing it out with different assets within that, or are they all publicly traded assets? So it's really balanced by offsetting industries and the variations of industries or sectors to balance it, and one's up, one's down, but you manage that in weathering your storms of one sector with the good performance of another sector.
Yeah, that's right. I mean, what we call in the industry variances and covariances, right? Variances are volatilities, so risk, and covariances are correlations, which is what you're getting at. And the fundamental idea behind diversification is to try to create a portfolio which has, and again, every portfolio is different because it has different objectives. But the idea of diversification, capital protection, risk management is to build a diversified portfolio so that there are things in the portfolio that when they go down, other things go up.
Yeah. And then also, well, since it's all public stock, I mean, because one of the things
in our case, yes, it's all publicly traded securities.
Right. So for that, back to the sole proprietor, if they have been carving out part of their profit and putting it into something that's liquid, like the public stock market, then when they would be able to get access to that cash, in theory, it's gained more than it would be in savings. If they are using an advisor that's balancing their portfolio and stuff like that, so that they can pick which ones to liquidate in the event they need to offset a struggle in their business.
Yeah, that's right. And I actually it reminds me of the professor I had at Chicago who had a favorite phrase, which was, there are a lot of benefits to liquid markets, right? And we're actually seeing that now. It's kind of good that you mentioned it, because again, a lot of high net worth, ultra high net worth clients who probably listen to your show are they're investing in lots of things, including private equity. And private equity has been just a go-go vehicle for a long time. And we're seeing now, and everything has positive and negatives. Everything has a role in a portfolio and things you should be careful of in a portfolio. For private equity, it's a very illiquid instrument and investment vehicle. And what's happened is, you can't cash out until the private equity fund cashes out, right? And the fund can only cash out when economic times are warranting cash outs, right? When they're essentially good. And with rates the way they are now, it's pushed out all these cash outs. So somebody who might have been expecting their private equity fund to come back in the next 5 to 6 years is now looking like at a 10-year time frame. Those are the kind of stories that are out there. Mileage will vary, but that's very, very illiquid for a lot of people, right? If you think of something you could invest in where you're gonna write the check today, but you're not going to get another check back for 10 years, you got to think about that investment. That you got to place that properly in your portfolio.
Right, right, right. Which is, why not to be offering financial advice on this podcast. But, that's one of the reasons why, sort of the rule of thumb, depending on your level of risk and your access to cash flow, is, it's usually only between 10 to 25% of an overall portfolio that is in angel investor private equity or those non-liquid private equity types of things, because you have to have income streams that might come from things that have specific rollout, throw offs and dividends, or income producing, types of assets and real estate, as well as your public stock market, right? But you can't, it's very, because of the uncertainty of what's going to happen in the future on that, it needs to be, and your financial advisor needs to help you figure out what's right for everybody listening here on what's the right mix for you. I mean, within what I teach in my training for angel investors to learn how to be an angel investor, I'm very clear on, the whole idea is, you got to plan on 10 investments. What that looks like is based off of your amount of capital available to invest over the next couple of years. And so what do those individual amounts might look like? But it needs to be balanced in that you've got some that are structured in such a way that they pay out an annuity like rental income along, so you've got something that's performing in that portfolio, along with a balance to nearer term, because they're pre-IPO stocks. You don't get as big a return, but you're going to get a return because you're buying them from employees that the company's getting ready to go public. And then you got your longer term that might take that 10 years plus whatever to get to, that could be the big win, but you've balanced it with these other ones so that you have a way, to mitigate the losses, and also not be completely tied up with nothing coming from it for a decade.
Yeah, that's right. And like, again, thank you for mentioning it. Yeah, to be clear to all your, nothing should be construed on this podcast as advice. We're not giving any financial advice here. But yeah, to your point, the principles of diversification that we've been talking about apply to the angel investor in those angel investments as well.
Exactly.
Right? Yeah.
Yeah. So as we get ready to wrap up, because I got to know if this is actually a joke, because I had the teaser, a retiree and a quant fund manager walk into a bar, but what's next?
So I like the image of a retiree and a quant fund manager, sort of sitting next to each other at a bar, right? And I raise it why the retiree, right? Is because a lot of life, whether you're retired or quasi-retired, or just going through a spell in your career where you're not generating, earnings. Income is very important to lots of people at lots of points in their life, particularly later in life, but at other points earlier in life, it can be as well. And so when we, again, as asset managers, we're tasked with thinking about how to deliver income over a very long time. And as we have aging society now, and people are living much, much longer than they used to, their retirements are getting longer. Some portion of that retirement is actually, productive, where people are still doing part-time work or even almost full-time work. Yeah. So they're pushing off the pure retirement until later because of longer periods of health. But the point is that the amount of time over which you're drawing income over a portfolio is growing. And so we've put a lot of energy at Markin into building portfolios that are going to do better for people who need to pull income. And I will give you the secret to the sauce of income is all about managing risk. It's all about managing risk. And the reason why is because you need to reliably be able to depend on writing yourself a check every month, right? That's what defines an income person. They need to be, so it's all about certainty. It's not just the amount of return, it's the certainty of return. And this changes, without going into any detail for another podcast, but this changes the mathematics of investing. Because it's not just how much return I'm going to get. It's the certainty of the return, the certainty that I can pay myself every single month, no matter what happens in the market.
Oh yeah. So I could see that because you don't want, that's the thing that really impacted so many people in the real estate bubble and then the melting of the financial markets, because so many people had, their retirement in the stock market, but without thinking about the potential volatility of that, and would they be able to draw a check every month off of whatever the net result was of that. And that was one of the reasons why the Jobs Act happened, was not just for entrepreneurs to be able to raise capital from other people besides the angel investor network groups, but also for people that had been participating in reward-based crowdfunding and buying some of this technology when it was first coming out, could have made good returns on those investments had that been equity instead of a a prototype of a drone or a 3D printer, right? When those companies went on to get big VC money or get bought, those people that had spent millions of dollars in that initial stage of that company going to market didn't receive any benefit of it. And so that was part of it. It's like, we can elevate both sides of the table. More entrepreneurs can get access to capital, and we can get more people, at whatever level of participating, that potentially can get a return, like the way the ultra net worth, high net worth people do when they do their angel investing, but at a
Over
smaller
any
scale.
10-year period of time, economists estimate that there's a 1/3 chance, about a 33% chance, that you will experience a Lehman style crash. Right. And
Yeah.
just for your, listeners who don't know, I know you know this, Karen, but that was a 7 to 10-year slog back, depending on how you were invested. And
Yeah.
if you were
Right.
invested in real estate, it was longer.
Yeah.
If you were
Yeah. Oh yeah.
concentrated in real estate, it was longer.
Right. Right. Yeah. That was, I was just looking that some of that stuff up for something else that I was working on. I was looking back to see, if my memory served me correctly on, the first domino that fell when we started to have that whole unraveling of financial markets and everything like that. So, okay, well,
And just to play that forward again, Karen, as an image, that 30% chance that that event could happen again over a 10-year period, over a 40-year retirement, right? That's a
yeah,
high percentage chance that you're going to get at least one of those events, and you're more likely to than not to get more than one of those events. So, so those risks are very real, and that's why so much work goes into risk management, capital protection, and ultimately income.
yeah. Well, and that's the thing I tell people when it comes to a regular performing public stock, not necessarily a hyped one that just went IPO and 2 or 3 weeks later, you know, drops, but your traditional blue chip type companies, right? That the thing about it is that, and you lose your money if you sell when it drops. If you have the luxury of being able to hold on to it, and it had good fundamentals to begin with when you did your research, or your financial advisor did their research, that they had, it was a good, fundamentally good investment, then it will rebound. It may take that sector may, cause stuff, or maybe an overall market rally like it did when they announced some of the stats and the reduction in interest rates and things like that a few weeks back. We saw one of the biggest rallies we'd had in, a year plus. And so, those things happen, but, unless you're a day trader, you really can't offset all of that volatility unless you think long term, right?
That's right. I mean, I think risk management is a combination of short-term thinking and long-term thinking. Certainly, that's the way our
Okay.
algorithms look at it. So risk management is something, you need to know how to act, and you need to know how to act quickly is one component of it to it. The other component is what you mentioned, though, Karen, which is the longer term, meaning build a portfolio that is inherently constructed. We call it portfolio construction, inherently constructed in such a way that even when things go bad, as they do, when they go bad, the portfolio has some natural resiliency built into it. And that's how risk management comes to this layered approach. Some of it is at the portfolio construction level, those lack of correlations that we talked about and that diversification we talked about it. But there also is, I will say, this more we have a lot of algorithms that work in real time to evaluate the situation and try to tell us, is this something really severe that's likely to persist, and give us a view on how severe of a risk management action we need to take.
Okay, great. All right, everybody, go to Markin Funds, MarkinFunds.com for more information and see some examples, get access to the blog and the other articles. Anything else you'd like to add, David, before we sign off? That
Not really. We covered a lot of ground here, Karen.
We did in our short period of time. So thank you very much for being a guest on the Compassionate Capitalist Show and bringing your insights and expertise in AI, machine language, and all of that quant stuff. It's just, I love the word quant. It's just, it's like quantitative analysis. That's what it's short for, everybody, I think, right? Is that what it's short for?
That's right. Yeah.
Okay. And like, but as it sounds, that's all kinds of data, right? The quantity of data, right? Quantitative, is that?
Yeah, quantitative data. Yeah, things that can be quantified, like where you can get to a number.
You can get to a number. That's right, and then analyze that, and and that's the thing. I think part of the volatility that we have in the marketplace now is really because we have so much computers and data analysis and so much data that sometimes when they adjust, do you find that because an adjustment will trigger another adjustment, and that's kind of the reason why you just sort of have to ride the wave, because it's all the computers doing adjustments against each other's adjustments?
Well, we're not high frequency traders, Karen, just to be clear. Like a high
But like the
frequency trader
market
is
in
more the
general.
paradigm that you're talking about, where
Okay.
minute by minute or even second by second, adjustments are happening based on what's going on in the market. There are definitely investors like that. We're not that high frequency of
Yeah, I knew that. I just thought about the market volatility in general when you've got 1,000 firms that are making decisions based off of some kind of
But to your
data.
question, yeah, it's a combination of what's going on in markets, but also fundamentals, what we call fundamentals, right? What is the fundamental state of the economy? What is the fundamental state of different sectors? Is there a war, a threat of a war, a risk of a war? All of this real-time, more news-oriented information or fundamental information is also something that we quantify and that goes into it. But it's absolutely a different type of information from, just some price went up and some other price went down.
Yeah. Okay. All right. With that, thank you very much, David. Onwards and upwards, everybody. Thank you for tuning in, and hopefully you found great value in this, and you'll like it and share it and all that good stuff. And go check out David's site and mine. And there's a little player after this on those that are listening in. You can get more information about my company and my services. Thank you. Onwards and upwards.